what is going on? I mean, on the one hand, you have an economy which is doing much better than most of the rest of the world, and on the other hand, you have a cautious Fed.
Well, whoever believed that central bankers knew what they were doing? And if you look at central banker forecasts, they've never been terribly accurate. We, as a culture, tend to place too much emphasis on their wisdom. But the fact is that this is, if thought correctly, I think, the more or less reverse of last year when they're jerking up rates, thinking everything's just peachy keen and too strong. Now they think this, that they don't have any great short to intermediate term forecasting ability or even ability to predict where markets would go. If you just flash back 11 years to 2008, they completely missed that downturn. And at the time, Janet Yellen in the October 2008 open market committee meetings was talking openly about how strong she thought things were. They don't have a clue, and they never have.
Okay,
and
but what's
getting too excited about them is a mistake.
What's influencing them the most, though, here, do you think? Because Jerome Powell, he was in Paris just yesterday saying that trade developments, global growth had caused uncertainties, the uncertainties upon which he wants to act. So I'm wondering how much his federal policy is weighted towards the global outlook as opposed to what's happening domestically.
So I think there's probably some of that, but I think there's a bigger thing that people miss, which is that central bankers almost everywhere pretend to not be political when they're actually secretly political all the time. And Powell, it will play a very careful role. He knows that any move that he makes in interest rates in the period a year from now through the November election will be seen as political. They like to be quiet then if they possibly can. So they don't get seen as political because the next president, Republican or Democrat, will reappoint or appoint the next head of the Fed. They know this inside out. You don't get into that position if you're not political. Look at the future head of the Eurobank. The fact of the matter is, in my opinion, they overmoved last year. He's going to reverse some of that this year, get it over and done early enough that it's before the elections, and then he doesn't look political next year. I think, meanwhile, he talks to posture that. It is true that the rest of the world isn't overall quite as strong as America, or at least certainly Europe isn't as strong. But the fact is, Europe is actually moving along. Switzerland's growing, but slowly. Manufacturing PMI is negative, but on the services side, which is much bigger, over twice as big as manufacturing in Switzerland, the world's positive. It's growing, but nicely. We have an almost overall global Goldilocks world of low growth, low inflation, and otherwise bouncing around a little bit, and the bouncing makes people nervous.
Coming back to talking again about the US, I mean, how much do the rate cuts have to do with national debt, which is, I mean, at a astonishing record high?
They don't at all. I mean, simply, that's wrong. While it is true, for example, that Switzerland has a very low amount of debt relative to GDP as a total, basically about 27%. The fact is, and America, of course, is on the high end of countries, not the very highest, but on the high end of countries. The fact is, interest payments on either U.S. government debt compared to GDP or compared to tax revenue in total are half of what they were in the early 80s and most of the 90s. What people miss, they just miss, is that interest rates have come down more than debt has gone up. So the carrying costs of the debt are actually much lower. The Fed can control short-term rates, but they can't control long-term rates. And this feature of interest rates coming down more than debt's gone up has made the carrying cost of the debt very serviceable over the next decade. And so these cuts aren't about debt.
But doesn't it then, I mean, low interest rate, don't they fuel even more global debt? And I mean, the amount of global debt is also at a record level, which we just saw. There was a study by the International Institute of Finance, where it says globally that is at record levels in terms of percentage of GDP.
Yes, and that's right. And then you play the game that says this, exactly. If interest rates short to long term go up by this amount over this period of time in the future, how much does that impact in a negative sense the carrying cost of the debt to the government or to the world, depending on what you're measuring? And the fact is, none of this can possibly happen in a time frame that will impact markets over the next few years. It's so far off into the future before short and long-term interest rates could rise enough to make the carrying costs of the debt a potential burden, with the exception, of course, of some lesser developed nations. But even, as I've said before, here, and as I've written about in my monthly column in Hedel Zeitung, even in Italy, that people talk about so much, the carrying costs of the debt, because they've extended the average duration of their debt, is at lower rates, is a fraction of what it used to be. I mean, it's literally 20 to 30% of what it used to be, depending on when you pick used to be. Mm-hmm. And therefore, it takes a long time to turn that around because of the portion that's long-term debt.
If I could just jump in at this point, I mean, we are now in a situation where we have stock markets which seem to be reaching record highs on an almost daily basis, and then we have loose monetary policy. I mean, how much is that driving economic inequality in the world at the moment?
You and I are going to disagree. We do not have loose monetary policy. We have low interest rate tight money. That's a very different thing. If we had loose monetary policy, which we do not, then the growth of the quantity of money would be growing at a relatively high rate compared to GDP growth. It is not in Switzerland, it is not in America, it is not across the Eurozone, and it's not around the world. The fact is, if you look just singularly at Switzerland...
So there is potential for the Fed to...
of course they could, but yes. But let's be clear what that means. By traditional theory, and people get this wrong always, loose money means you're growing the quantity of money at an abundant rate, at a faster rate than the growth of the economy by some market amount. If you look at Switzerland, I just looked at this not too long ago. I'm not current for the last month or so, but the growth of the quantity of money more or less equals GDP growth plus about 0.5%. And that is not loose money. Mm-hmm. The fact is, in America, it's not loose money. We've got low interest rate, tight money because central banks, through quantitative easing, have flattened the yield curve. And at that flattening of the yield curve that causes the banks not to loan money, and if the banks won't loan money at an abundant rate, if you don't have heavy loan growth, you don't get loose money.
Mm-hmm. And how does all this affect, or why should Switzerland care about what the Fed does later this month?
You know, if I were Switzerland, I wouldn't care so much because of what I talked about when I was on the show the last time, which is the spread between major developed nation rates relative to the hedging costs of moving money from one country to another. If, in fact, the Fed moves rates up 0.25%, let's say, all that does is varies where major entities, I mean, literally, Nestle is the most important singular piece of the Swiss economy, where major global companies borrow from and lend to, where major global banks borrow from and lend to, because they can borrow in any country and lend into any country they operate in.
So what are you telling investors?
This will have this much effect.
So what are you telling investors?
What I'm saying to investors is that when sentiment is negative, and everything we've been talking about is reflections of negative sentiment, when sentiment is negative, markets do pretty well. Like going back to Nestle for a second, just look at the stock. Look at the SPI, which is dominated by Nestle. And, you know, the Swiss market, because of Nestle, has actually done better this year than the U.S. market, a point most people don't really think about.